Matt the Mortgage Guy here. Wanted to record a quick video to talk about some changes in the world of government lending. I've got a lot of realtor partners, a lot of clients, a lot of referral partners that I've been talking to on a daily basis, trying to keep everybody updated. And I thought to myself, why don't I record a video? And so for anybody watching, this is going to be a quick overview on some of the basics. I'm not going to get into the nitty-gritty fancy mortgage terms and the back end reason of why this is happening, but I'm going to talk about what has happened, what has changed, and what you can expect as a borrower or as a realtor working with borrowers. In the last couple weeks, FHA guidelines, VA guidelines, USDA guidelines, anything government loan based has changed quite a bit. All loans, some guidelines have changed, some programs have disappeared, and some, like the government stuff I'll talk about, they've just changed their buckets on what they're going to accept, whether that be a higher credit score, a higher reserve amount, or longer time on the job. And so just to give you a basic overview, I just want to tell you what time it is. I'm not going to tell you how the watch works, and I love using that analogy because I really just want to keep it basics, give people an understanding. So some things that you should know have already changed and that you'll see across all different lenders. And an important thing to remember is that different lenders are going to do different things. Certain lenders are going to say, hey, we're still going to lend down to 580, but we're going to require X number of reserves. Some lenders are going to say, hey, we require a 640 credit score. Others, 660, some even 680 I've seen. So it's important to, as a consumer, get really clear with whoever you're working with on whether or not you qualify. If you don't, you might want to try somebody else. If you're working with an independent broker, we can shop a few different and kind of know where you're going to fit as far as qualifying goes. But in the past, just for reference, pre-mid-March, we could do FHA loans at a bunch of different lenders, down to 500 credit score. 500 to 580, you could do 10% down and get an FHA loan. 580 and up, you only had to put 3.5% down, and there was a ton of different lenders that had an appetite for these loans. What has happened is a lot of them have shrunk that, whatever you want to call it, bucket or guidelines of what they need. And some of them are saying, if you have a 640 credit score, we can still do the loan, but we want you to have 3 months of reserves. Others are saying we want 660. Others have even implemented like a 5 years at the current job requirement. And so it's really different everywhere, so it's hard to give clear and concise guidelines because it's going to be different everywhere. Will this last forever? No. But for the foreseeable future, if you're trying to get a government loan, you should know these things and be prepared. Maybe 2 months ago, you got pre-approved, and I could buy a house up to $350,000 and put 3.5% down. That's the only money I got. I've got a 642 credit score. I'm good to go. You want to relook at that. And one thing I do want to mention to the consumers, to the real estate agents, to anybody that's watching this video is, I wouldn't view this as a negative thing. I would view this as lenders being more responsible. And as somebody who looks at a ton of different scenarios, I can tell you that there are certain people that you'll look at their scenario and say, you know what? As much as I'd really try to get this person pre-approved to buy a house, it probably serves them better to get in a better place where they've got a few months of reserves, they've got their credit cleaned up a little bit, and they're in a stronger position so that this turns into, a dream versus a nightmare. Because as you can imagine, somebody with a 587 credit score who's got no reserves, meaning once they close this loan, they've got no money. And 3 months reserves, just to clear that up, what that means is if you got a $2,000 mortgage payment, 3 months of reserves is $6,000 in the bank. And that's probably a good idea, that folks have some reserves in the bank when they're closing on a loan, because if something happens, like no one predicted what happened with this global pandemic in 2020, but for folks to have a little bit of cash on the side when they buy a house is a good idea. So that's kind of an overview. I'm happy to answer any questions if any realtors want to call me and discuss and chat about things that are going on. This is a super fluid situation, so it's changing every day. What I talk about on this video on March 30th, 2020 might be different come the first week of April. It might be totally different come December of 2020. But for now, the buckets and the qualifying criteria for all government loans has changed fairly dramatically, in my opinion. Conventional loans, some lenders are coming out with new requirements for investment properties where you got to have more reserves for those. Others are changing, their debt to income ratios. Those are coming down, where before you could, have a debt to income ratio of 50, and some of them want 45, some of them want 40. So check with your lender if you're in the process of buying a house. If you're a realtor and you've got borrowers who are pre-qualified, mid-March, you definitely want them to get back in touch with their loan officer and make sure you're not writing offers for somebody who might not be able to close on a loan.